Do you have grandchildren and you're wondering whether or not you should start a 529 plan to help them save for their education? Hi, my name is Zach Morris with Paces Ferry Wealth Advisors, and I want to talk to you about some of the features and benefits of a 529 plan, specifically as it pertains to you as a grandparent and how you can help your grandchild save for their education and also help your adult children ease their financial burden when it comes to paying for their kids' education. First, I want to talk to you about what a 529 plan can be used for. The 529 plan receives money after tax, it grows tax-free, and then the money comes out tax-free for qualified educational expenses. Now, there's a new feature of the 529 plan in the last couple of years that allows them to be used for K through 12. Now, K through 12, it can only be used up to $10,000. For higher education, it can be used for tuition and fees, books and supplies, software, computers, internet access, and even room and board. Now, for room and board, your grandchild can't get a off-campus housing for $3,000 a month and call it room and board. It has to be somewhat equivalent to what they could get on campus. I'll say room and board with that caveat. However, it can be used for room and board. It can also be used for student loans up to $10,000. So K through 12, up to $10,000 a year, as well as all these other qualified educational expenses. The student loans is actually new in the last few years, as well as the K through 12 up to $10,000 was a change that was made in the last couple of years. So now how can you fund a 529 plan? You have a couple of different options for funding a 529 plan. And really, as a grandparent, I want you to also think about this as a strategy for your estate planning, because it's a great way to get money to the next generation or even future generations without having to use up your lifetime exemption. So today, the lifetime exemption is an elevated amount of $13.61 million in 2024. And of course, this is set to sunset in 2026. Today, we're not going to talk about that because all you need to use to fund a 529 plan is your annual gift exemption. So in 2024, that annual gift amount is $18,000. Your annual gift amount in 2025 is going to be $19,000. And that is the amount that you can give to any one person. So you can give $18,000 in 2024 to your grandchild, you can give it to your child, you can give it to your best friend, anybody that you want to if you're a great friend. So that $18,000 can also be doubled if you're married. So you and your spouse can each give $18,000. So let's use the example of a 529 plan. You and your spouse can each give $18,000 to that 529 plan this year. That means that you could put a total of $36,000 into that 529 plan at one time. Now, this is one thing that a lot of people don't know about is that 529 plans allow for something called super funding, whereby you can give 5 years worth of those gifts, worth of that $18,000, you can give 5 years worth all at once. So you can give $18,000 5 times and your spouse can give $18,000 5 times. So you can give $90,000, your spouse can give $90,000, which means you could give $180,000 like that. Again, that $180,000 is an amount that will go into the 529 plan. It will grow tax-free and come out tax-free for qualified educational expenses. Now, let's assume for a second that you have 5 grandchildren. Using the super funding, you can give $90,000 to each grandchild. Your spouse can give $90,000 to each grandchild. So you can give $180,000 to each grandchild. Assuming that you have 5 grandchildren, you can give $900,000 out of your estate with one fell swoop. And that is only considered an annual gift. Now, that utilizes your annual gift for the next 5 years. So you have to take into consideration any life insurance trust that you might have had with that grandchild as a beneficiary, any other gifts that you might have given to that grandchild, not your child. You can still give your child that $18,000 gift or $19,000 in 2025, but this uses up all of the gifts to that grandchild for the next 5 years. Now, one caveat to the super funding is that you have to live throughout the superfunding period. If you die in the 4th year of that 5-year period, then 20% of that superfunding, 20% of that would be included in your gross estate. So remember that $900,000 was pushed out of your estate, is no longer included in your estate when you die. However, if you die in that 4th year, 1 year's worth of gifts would be pulled back into your gross estate for federal estate tax purposes, potentially even state tax purposes, depending on what state you live in. You might be asking the question, how much should I fund? Okay, Zach, you say I can put $900,000 in if I have 5 grandchildren, but how much should I put into the 529 plan? My advice to grandparents is going to be much different than it is for parents. With parents, you're early on in your careers too. So you're saving for your financial future as well as your child's financial future. So when a parent is funding the 529 plan, my advice is very different. I say take it slow. For a grandparent, you know where you stand financially. You know where you stand financially. You know what your financial plan looks like. You might even be years into retirement at this time. And really, this gift could be looked at as an estate planning gift. It could be looked at as an estate planning gift. It could be looked at as a way to help your children with their financial futures and do so tax efficiently. So there's a number of different reasons, and there's a number of different things to take into consideration as a grandparent and how much you could fund a 529 plan. Now, you may ask the question, well, what if they don't need all the money? What if I put all this money into the 529 plan and then my grandchild gets a scholarship? Well, there's a solution for that. What if they don't go to college? There's a solution for that too. The 529 plan can be transferred to any family of the beneficiary. In this case, your grandchild is considered the beneficiary. And in the eyes of the IRS, the term family is fairly broad. And here's what I mean. Family, in the eyes of the IRS, has an expansive definition. It can be the son, daughter, stepchild, foster child, adopted child, or descendant of any of them. It could be the brother, sister, stepbrother, stepsister, father, mother, ancestor of either, son or daughter, or a brother or sister. This includes nieces and nephews. It could also be a stepfather or stepmother, son-in-law, daughter-in-law, father-in-law, mother-in-law, brother-in-law, sister-in-law, and then it could also be the spouse of any individual that I've listed so far. In addition to that, it could also be first cousins. So you as a grandparent don't have to worry as much about this money being utilized. If it needs to be transferred to a cousin, you want to make sure that your kids get along. However, if one child decides not to go to college, it can be transferred to somebody else. It could be even transferred to your adult child if they decide to go back to school to get a graduate degree. Now, let's assume for a second that your grandchild gets a scholarship, which, depending on the grandchild, could be they could get a partial scholarship, they could get a full scholarship, and now the money's in the 529 plan and you don't need it anymore. However, they can still use it for room and board. Right? They could still use it for books, computers, internet access, and 529 plans allow you to pull the amount up to the amount of the scholarship without penalty. So I'll cover that penalty real quick. If you pull money out of a 529 plan for any reason other than I've covered so far in this video, qualified educational expenses or K through 12, up to $10,000, you pay a penalty on that amount, which is 10% penalty, and you also pay taxes on the earnings. So you pay taxes on the earnings as well as a 10% penalty. If, however, you pull out an amount up to the amount of a scholarship, so you go to the registrar's office, say, I need a printout that shows the value of my scholarship. That's all your grandchild has to do. You get that amount, and then you can pull that exact amount out of the 529 plan. You're going to pay taxes on the earnings, so not the basis, but the earnings, but you're not going to pay a 10% penalty. So that is your get out of jail free card if your grandchild gets a scholarship. Now, the last feature of the 529 plan that I want to discuss with you is new and actually just became available in 2024, and it's the ability to convert funds that are still left in a 529 plan to a Roth IRA. So this is how, even if your grandchild still has money left over and they start their careers, they can use the amount in their 529 plan up to $35,000. So up to $35,000 total, they can roll to a Roth IRA. Here's how this works. The $35,000 is the total amount that they can roll over the life of the 529 plan. They can roll up to the limit on an annual basis, and that limit is the Roth IRA limit. So in 2024, that Roth IRA limit is $7,000. They can roll up to their earned income amount. So if they have $7,000 worth of earned income, they can roll $7,000 into a Roth IRA. Now, Roth IRAs are typically going to be restricted based on the income of your grandchild in this example. So if your grandchild gets out of college and gets some high paying job right out of college, they're making $300,000 a year, it's possible that they cannot contribute directly to a Roth because they make too much money. However, if they have funds in a 529 plan, they can contribute to a Roth. So because they're rolling from the 529 plan, they can roll that amount directly into a Roth, and they're not subject to the income limits that are typically applied to a Roth IRA. A couple of things to look out for when implementing this strategy, and I always recommend that you check with a qualified tax attorney before implementing any tax strategies. One thing that you need to look out for is that the 529 plan must have been owned for 15 years prior to implementing this strategy. The second thing to look out for is the 5-year look back rule on contributions into the 529 plan. So only contributions made more than 5 years prior are eligible for a rollover to a Roth IRA. Earnings on contributions made in the last 5 years are also ineligible for rollover. And the last thing to consider is that the 529 plan beneficiary must also be the owner of the Roth IRA. So you can't take money from one person's 529 plan and contribute to someone else's Roth IRA. If you've enjoyed this video, please subscribe below. Be on the lookout for more content in the future. Thank you.